Is it possible that one of these 4 high-yield dividend funds is a great way to invest your money, perhaps even better than QYLD? Alright guys, we're talking about 4 different funds here. One of them we've actually already featured recently, which is QQQX from Nuveen. We compare that directly to QYLD as well as QYLG, hoping to find the best way to invest into the NASDAQ 100 but also prioritize cash flow. But in this video, we're taking a look at the other funds in addition from Nuveen that track the S&P 500 as well as the Dow Jones Industrial Average. And as customary, I built out a unique spreadsheet just for this video so we can compare not only just how the portfolio balance looks, but also the dividend income and how those things change over time. First off, we have SPXX, which is the Nuveen S&P 500 Dynamic Overwrite Fund. Then we have the Nuveen S&P 500 Buy Right Income Fund, which they're similar but not quite the same. Then we have QYLD, which we'll talk about. We already talked quite a bit about. QQQX, which we've already talked about, the NASDAQ 100 Dynamic Overwrite Fund, and then DIAX, the Nuveen Dow 30 Dynamic Overwrite Fund. These investments are all very similar in that they take the underlying index, they invest into it, the NASDAQ 100, S&P 500, Dow Jones 30, and then above and beyond those investments, they then sell covered calls. Now we know with QYLD, they sell calls on 100% of the portfolio right at the money. These investments do not take that exact same strategy. Let's take a look at SPXX first, the Nuveen S&P 500 Dynamic Overwrite Fund. This one is very similar to QQQX, except the underlying index here is the S&P 500 right here, not the NASDAQ 100. And just like QQQX, they own the underlying index and then they sell call options on 35 to 75% of the portfolio. So instead of writing 100% like QYLD, they write 35 to 75% with a long-term average or goal of 55%. The reason why they do this is they like to prioritize both growth in the underlying assets as well as premium or option premium from the selling the call options, which generates income for investors. And one of the biggest differences between these Nuveen funds and the QYLD funds, everything from Global X, is these are quarterly distributions as opposed to monthly. This fund has a distribution rate of 6.68% and a long-term average annual total return of 7.17%. All right, next up, let's take a look at BXMX, which is very similar. It's the Nuveen S&P 500 Buy Right Fund. Now you might be thinking to yourself, what is the difference here? It's not a big difference. The market distribution rate is 6.62%, and what it says here is that the fund seeks attractive total returns with less volatility by investing in an equity portfolio, blah, 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 and selling indexed call options covering approximately 100% of the fund's equity portfolio. Now, you would think that given the fact that it's covering 100% of the portfolio that there would be more income here, but in actuality, it's not. If you notice here, it says the distribution rate is 6.62%, which is actually very similar to SPXX at 6.68%. And so here we have the Nuveen Dow 30 Dynamic Overwrite Fund, DIAX. Very similar to the other funds. It's got a 6.78% distribution rate, just like the others here. It owns the underlying index, the Dow Jones Industrial Average, the Dow 30. These are the 30 largest companies in the United States. And then above and beyond that, like the others, they sell call options on approximately 35 to 75% of the value of the portfolio with that long-term target of 55%. These are the top holdings in this portfolio: United Health Group, Goldman Sachs, Microsoft, Home Depot, McDonald's, Amgen, Caterpillar, Visa, Salesforce.com, and Honeywell International, and a total of 38 different holdings. So you can see how these funds are very similar in many ways to the other funds we've looked at, QYLD, QYLG, XYLD, RYLD, in that they have an underlying portfolio that they write options on. The big difference with Nuveen funds compared to Global X, with QYLD, RYLD, XYLD, is that number one, they're paid quarterly instead of monthly, and secondly, there's a little bit more flexibility in how they write their options. There are rigid rules with Global X. They write at the money, or they write exactly 50% of the portfolio every time, whereas here there's a little bit of flexibility to, based on market dynamics, maybe make some adjustments along the way, which one would assume would result in outperformance, or at least maybe capturing more growth or writing options at the right time. All right, time to take a look at the actual spreadsheet that I created and look at the data to see just how these funds performed historically against each other as well as against QYLD. All right, so here's the spreadsheet. Now we've got our 5 different funds, including QYLD. We're going to look at 2 separate, distinct timeframes. The first time frame we're going to look at is right here, February of 2007 to present. And for this, we can actually look at 3 of the actual investments. We can look at SPXX right here, we can look at BXMX, and we can look at QQQX. DIAX was not launched yet, and QYLD also not launched yet. And then the second time frame is right here, December 2014 to present. This will allow us to use all 5 of the investments to see how they perform across 3 different strategies. We'll look at monthly contributions right here. We will look at lump sum investment and lump sum plus monthly. So monthly contributions is starting from $0, reinvesting all dividends, and making monthly contributions every single month, which will be $250 a month for our example. The lump sum strategy is starting with a significant amount of money. We're going to use $100,000 in this case. We're not going to add any new money to the portfolio during that time, and we are not going to reinvest any dividends. The purpose of this strategy is to identify if we had a portfolio we were ready to retire now, we wouldn't add new money and we wouldn't reinvest dividends. We'd just be living off the assets. We'd be wanting to see just how these investments perform over the long term, and meant, again, to replicate being retired living off of the investment. And then lastly, we've got lump sum plus monthly. This is where we start with a lump sum of money, $100,000, and we make $250 a month contributions, and we are reinvesting all dividends. This is a modification of the monthly contribution strategy where we're just starting with more money up front, we're still reinvesting all dividends and making additional monthly contributions. And then within each strategy, we'll look at annual dividend income for the trailing 12 months, total dividend earned, and portfolio value. Portfolio value is very straightforward. Total dividends earned is the cumulative amount of money earned in distributions from the investment over the entire time frame. And then annual dividend income is looking at the most recent 12 months that have occurred. What is the actual income earned for the year? Let's take a look first off here for monthly contributions under this first time frame back to 2007. This will include the Great Recession, so we'll see how these investments actually perform. All right, first off, looking at annual dividend income for the trailing 12 months, we can see here that QQQX by far and away outperforms the other two. $9,000 in the most recent year in annual dividend income. This is starting from $0 too, which is pretty amazing. Whereas the other two investments are similar, but we've got SPXX at $5,800 and then $5,613 for BXMX. Looking at cumulative dividend income earned, we've got $40,000 here for SPXX. Same thing, very close for BXMX at $4,808, and then $53,898 for QQQX. So significantly more dividend income earned, and much more in the most recent trailing 12 months. We also find here that if we look at portfolio value, again, running away with it is QQQX, worth $136,000, whereas we have $103,000 here for SPXX and $94,000 for BXMX. Let's take a look at the lump sum investment strategy here, meant to replicate being retired, living off your assets. All right, so annual dividend income for the trailing 12 months, we've got QQQX outperforming big time here, $9,150 in annual dividend income versus only $4,574 for BXMX and $5,163 for SPXX. If we're looking at the total cumulative dividend income earned, we've got $114,000 for QQQX, $86,000 for BXMX, and $85,000 for SPXX. And then lastly, looking at portfolio value, again, QQQX running away with it, $131,000 here versus $87,000 and $86,000 for the other two. All right, so if we're looking at lump sum plus monthly contributions, again, top result here, QQQX at $18,189 versus $10,900 for SPXX and $10,100 for BXMX. Total dividend income earned, much higher again for QQQX at $168 versus $125 and $127 for SPXX and BXMX, both from the S&P 500. And then lastly here, portfolio value. We would end up with $268,036 compared to $190 for SPXX and $167 for BXMX. Now what I do find fascinating here is between the two S&P 500 funds, the dynamic versus the buy right, again the dynamic is where they only write on 50% of the portfolio, long-term goal, versus 100% with this fund right here. The portfolio value was definitely higher, which we anticipated with the 50% writing strategy here. But I noticed that the dividend income is actually just as competitive as BXMX, which I found surprising given that they're only writing options only half the portfolio. So clearly here, looking at this first time frame, it's just a runaway here. QQQX outperforms by far the other two investments that focus on the S&P 500. But let's take a look at a different time frame. We'll look at December of 2014 to present. You're going to use all 5 investments to see how they perform, which one comes out on top. First off, we'll look at monthly contributions, again starting from $0 and reinvesting all dividends. All right, first off, looking at annual dividend income based on the trailing 12 months, the top result is QYLD, earning $3,680.55, with second place going to QQQX at $22.63, closely followed behind BXMX at $21.80 and 95 cents. DIAX and SPXX both bring up the rear around $1,800 annually. Looking at cumulative dividend income earned, we have first place again, QYLD at $11.5. Then we've got second place, BXMX at $8,005.86. Third place being QQQX at $78.74, and then the other two bringing up the rear, DIAX and SPXX. And then looking at portfolio value, top result here was actually QQQX at $35,149, with second place being SPXX up here at $33.3, and then we've got $32.5, $30, and $30 with QYLD and DIAX. All right, let's take a look at the lump sum investment strategy. We're trying to replicate what it would look like to actually retire, starting with $100,000. In this situation, we would have the top result be QYLD, which brings back $11,664 in annual trailing 12 months of dividend income. Second place would be QQQX at $87.70. Then we've got 78, 7, and 65 between BXMX, SPXX, and then DIAX. Cumulative dividend income, again, first place goes to QYLD, then followed by BXMX at 58,000, then we've got 55 right here, 52 right here, and then down to 47 with DIAX. And then lastly here, this one I find fascinating. We're starting with $100,000 here, and we're not reinvesting dividends, and nor am I counting it in the value, but let's just say you're living off of the dividends. What portfolio value is actually growing versus which ones are actually dropping in value? We've got $125,000 here for QQQX, which is good for first place. I start with 100. Living off the dividends, you still have 125.9 after, 7 years, 8 years? Then we've got second place 119,000 with SPXX. Then we've got 107,000 BXMX, and then we've got our two problem children over here, for lack of a better term. Both investments are worth less than what we bought them for. $100,000 portfolio value for QYLD and DIAX, and we end up with $99,000, so just a hair under our normal value with DIAX, but then $85,000 with QYLD. So again, we get that outperformance when it comes to the dividend income from QYLD, but as we've seen again in the spreadsheets, it doesn't do a great job of maintaining its capital value. So if for some reason you need this money for any other reason in the future, it's likely going to be worth less than what you got it for. Last one to look at here, lump sum plus monthly contributions. Then we'll take a look at all of the graphs. All right, so in this case, we've got first place going to QYLD with $15,000 in annual dividend income in our most recent year. Then we've got $11,000 for QQQX, $10,000 here for BXMX, and then $88 and $84 here. With total dividend income earned, again, far and running away with it is QYLD at $83,000. And then we've got, bringing up the rear, way in the rear, $66 here in total income for BXMX, $63, $59, and then down here $54. And then portfolio value. This is always interesting, especially when we talk about QYLD. Top result here is $161,000 with QQQX. Next result is $152 up here for SPXX. Then we've got, bringing up the rear, $140, $130, and then in last place, again, QYLD, $116,000. So again, we find QYLD, massive income, struggles to maintain its portfolio value. We can see that SPXX is a pretty balanced fund here. It's got pretty good dividend income, but it does a really good job of maintaining its portfolio value, as does QQQX. All right, time to look at the spreadsheets here to see how this data looked over time. Sometimes it can give us some trending information. All right, first graph here is from February 2007 to present. This is looking at just those three investments from that time frame that were available, which is QQQX, SPXX, and BXMX, which are those last two are the S&P 500 underlying index. We can see here that QQQX, pretty much from the outset, does a better job here. It really starts to pull away starting in 2012, 2013. And then it really takes off here in 2018, drops big here in late 2018, early 2019, big COVID drop here with the other two, and then that's where it really takes off here and just flies away from the other two investments. This is our graph here to show the starting with $100,000, what happens over time with not dripping any additional dividends into the portfolio. From the outset, after this drop here in the housing crisis here in 2008, 2009, we then have kind of sideways movement for a few years, and then that's when QQQX really takes off here for a number of years, and it's just, they both all drop again for COVID, but it's just far and away outperforming the other investments. And what I think is pretty unique here is that while QQQX was worth a lot more, 100 versus what now, 130, 140, these two could not even maintain their original value. They were both less than $100,000. All right, last graph here for this time frame shows that lump sum plus monthly contributions with reinvesting dividends. We again see the same kind of idea here. QQQX really pulling away from the other two investments between 2011 and 2014, and then a real taking off from after the COVID drop. All right, here's our second time frame, December 2014 to present, all 5 investments. And this is from monthly contributions starting from $0. Pretty much all stuck together, all the investments here, except here at the end, we've got QQQX with respect to portfolio value taking off here from the others. And at the end, a little bit higher than SPXX. Here's that lump sum investing strategy where we're not reinvesting dividends. We can see everything is very close together, worth about the same thing. The only big difference here is QQQX taking off after COVID, and due to the significant drop over the past, I'll call it maybe 5 to 6 months, we're seeing really close results between this and SPXX in white. And then here's the graph of the lump sum plus monthly contributions while reinvesting dividends. And again, all the information is very close together here, except once COVID hits and the recovery starts much faster for QQQX, that's where you see it take off here, almost get caught by SPXX, and then at the end here, still worth a tad bit more than SPXX. So in doing this analysis, I noticed that, number one, I hadn't seen a covered call fund or ETF covering the Dow Jones Industrial 30. And honestly, it didn't perform very well. It didn't have great portfolio value. It didn't have great dividend income. It was just kind of blah. Like we saw with Global X ETFs, we found that the S&P 500 just doesn't have as much volatility as the NASDAQ 100. So as a result, we're going to get better performance. We did get better performance here with the NASDAQ 100 fund, QQQX and QYLD, as compared to the other investments. For me personally, I'm not going to touch the Dow Jones 30 covered call ETF, and I'm probably not going to touch the S&P 500 investments either. I may think seriously about including QQQX, where we've got the NASDAQ 100, we've got call options, but we've got that extra flexibility in how we write the options and for how long, etc. If you like this video, guys, check out this one right over here. It's going to be a great next step for you in learning more about covered call ETFs and finding the right type of cash flow portfolio. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.